Well, this is going to be my second upload 2 consecutive days in a row. Absolutely insane. I never thought that I would be uploading videos this frequently, but here I am. You guys absolutely killed it in the last video, and I just couldn't let you guys hang. After uploading that last video, the channel actually gained 150 subscribers, which is just absolutely mind-blowing. And I think this video is actually going to be very entertaining for you guys and actually educational as well. A viewer sent me a video of him demonstrating or explaining a strategy that he has been working on, and he was asking for me to critique it. And after taking a look at the video he sent me, I think he's really thinking about the right things, and I would urge any of you guys that are watching this video and you don't currently have a trading plan or a strategy to think about what it is that he is looking for and then take into account the advice that I'm offering to help you form a strategy or style that is unique to yourself. And we're about to dive right in, but before we do, I just want to briefly ask you guys to please smash the like button and subscribe if you haven't already. As silly as it sounds, I actually do feel very good when I see that a video gets likes or that people are subscribing, because it's the only form of progress I have when I'm uploading these videos to continue feeling motivated to do so. I don't have a monetized channel, so the only metric by which I can kind of drive myself to do better is views, likes, and subscribers, and every single like and subscribe helps me out and makes me feel very happy. With that being said, let's hop right into it.
Hi, Eric. I'm more looking for your advice on, I guess, mistakes that I'm potentially making with this sort of setup. Um, so I don't really know what this is called. So these are really my conditions.
So in the video, he went on to talk about his rules, but I'm just going to briefly go through the rules for him and explain very briefly what it is that he's looking for. So what he has currently laid out is that he is going to trade stocks that are attempting to break out or break down, and they have failed 3 times. And then he's also looking to have a 2-to-1 risk to reward ratio at the bare minimum. And lastly, it has to have 1 minute of action minimum, meaning that if it were to test a certain breakout or breakdown level in a 10-second interval, where it were to test it 3 times, that wouldn't be sufficient for him. It would have to have happened over the course of more than 1 minute. And I think the reason why he's doing that is because he just wants it to be a little bit of a longer time frame so that he doesn't really get faked out as often. And then lastly, he wants to exit within 3 minutes, and he actually specified this as to why he has this as a rule in our Discord message. And the reason why is because he has a little bit of anxiousness during trades, and by shortening the amount of time he's in a trade, he's able to manage the anxiousness better. And to work on improving your plan, I do actually have a suggestion, and the suggestion is to try to specify the type of stocks that will respect the strategy that you have developed the best. And for an example, I actually really struggle to trade larger cap stocks. Like even today I traded for about 30 minutes and I made just shy of $120. I think it was $116 in about 30 minutes of trading. And I traded 3 small cap stocks, and all of them I traded with very high accuracy and I made money on. But there was one stock, and it was Plug, PLUG, and it had a 300 million share float. And now this is way outside of my range, which I normally trade. Like if you were to see my plan, my trading plan, I definitely specify that I will only trade stocks with a float between 3 to 100 million. So you should definitely take a look at the type of stocks that you'll be able to trade and read better, because some people can specialize in large caps, other people like myself can specialize in small caps. There's a big range. You should be looking at what volume do you perform the best at. I don't know. There's a lot of different things that you can consider, and definitely try to figure out which stocks that you play best with.
And this is a if condition. So if we take this, it's not a very good stock, but let's say that we're at 518, we see a couple of levels above 610 with a sort of gap in between it is more ideal for me to enter above 610 and go for a climb up $9, simply because there are less significant levels above where I am at the moment, and that's what sort of this statement means.
So, what I got from that is that he has introduced a caveat where if there is no significant resistance or support below the level that is in question, even if all of the criteria he's looking for are present, he won't take that trade because if it were to break through that level, then there's nothing to stop it from like keeping on going. And if that's the case, then it would be better just to see and hope that it breaks that level because you can capitalize way more playing the other side of the trade. And in the situation he gave, I just want to point out that this is called a gap close. This isn't relevant to a strategy, but you can see that there was a very large gap down in this situation and above that level of resistance which he had drawn. If it were to break above, and it looks like it said 610, if it were to break above, it would actually look to fill that gap, which is what we call a gap close.
So I'll show you how I trade. Most of the time, I trade within the first 10 minutes of market open.
So, here are my thoughts on what you said about trading the first 10 minutes. Obviously, as day traders, volume and volatility are very important, and it's honestly our best friend because without volatility, we don't really have the opportunity to make a lot of money because we need price fluctuations to capitalize on. And then volume is really good because it provides liquidity, which allows us to be able to get in and out of trades very quickly. And then if you're doing what I'm doing, which it seems that you are, you're scalping to a degree. And if you're unable to get out of a trade quickly, that is a huge liability that we do not want to deal with. So you trading the first 10 minutes of the day at market open is where there is a height or a peak of volume and volatility. So I'm definitely with that. But on the other hand, the issue that I have with what you said is that you're only trading the first 10 minutes. That is not a lot of opportunity. I think that being able to trade an hour or even 90 minutes is really, really important. And if you were to spend more time trading, you would see that you would be making a lot more money, assuming that you are able to trade profitably as is.
Um, and so I mostly look at just the tape and a little bit of the chart candles. So to make it really brief, I look at how the tape is moving and then trade based on the psychology of the tape. So I'll show you an example. So we've got 10 seconds till market open, and also charted the significant levels in the pre-market as well as the past year.
All right, guys, so this is very good. I think that every aspiring day trader should already know this, but support and resistance is really key. Every single day, for every stock you trade, you should have already marked the intraday support and resistance, the pre-market support and resistance, and then look at the daily chart and mark the support and resistance. This is really, really important because it can save you a lot of money. If you don't know where the support and resistance are, it can really screw you. So please, for anybody watching, if you don't already, maybe you're new to trading and you're just getting into it and figuring things out, know how to do support and resistance. It's very, very easy. It's not complicated at all, and it will have a significant impact on your trading ability.
Um, on my support and resistance. So we've got market open. Looking at the tape, we see it climbing back up with that much resistance. We see 560, we see 570. Okay, it's coming 580. So it struggles to go past 580. So that's the significant level, consistent with what we drew before. Now it's going back to 560. So what this tells me, we spent a lot of time around 560. So 560 is a level the buyers and sellers are willing to fight over for. In this particular case, it's in favor of the buyers because it's relatively close to the closest resistance level for a breakout. So my interpretation of the psychology is that buyers are in control in this particular minute, battling around 560, looking for a squeeze past 580. So we have one attempt to break resistance. You broke and you fell straight back down to 560.
So what we just saw is that we had a test of 580 and it actually broke through. I think I saw a high of 584 on that candle, but it turned out to be a false break and it came back down to the 560-ish level. And there's a couple things that we can think about regarding this level, and I think that it's worth mentioning because it might be able to help you out or other people watching and thinking about and evaluating different forms of strategies. So the first thing that I would like to think about this false break is that it requires significant buyers to break through a resistance level, and how quickly it broke down from 584 down to 560. The people that bought in at 580 to break through that level are probably still holding their shares. And what this means is, at least coming from my perspective, if I were bought in at 580 and we're now 20 cents below my entry, I would be a little bit upset because at $5.80, I would probably be buying near 1,000 shares, which would mean I would be down $200 on this trade. So what could happen is I could either sell my shares, which would be providing more selling pressure, or I could hold on, and then the next time we come up to test 5.8, I would sell for break even. And what does that mean? It means that it's now going to be more difficult and require more buying to break through 5.8 the next time we test it, because there's going to be a lot of people like myself who are going to be wanting to sell for break even. Now, the other thing that we can think about in regards to the people that bought at 5.8 are the people who aren't like myself and people who would like, because I personally would be selling like right away. I'm very quick to get out of a position if I'm losing on it. But some people like to hold and go for break even. So what happens right here if instead of it going up and testing 5.8 again, which we would think it would get rejected if it goes back up to 5.8, but instead it continues to go down? Eventually those people have to have some sort of risk tolerance, right? I don't think they're just going to hold it forever. And I mean, there are some people that do, and they're bag holders, but there's just other people who have a larger risk tolerance. So let's say this gets down to either 540, 520. Every single cent it comes down, there's going to be people that had bought in up at that 5.8 level, or people even just above the current price that are going to be selling. And this is what we would call a not a short squeeze, but a long squeeze. I feel like a lot of people hear the term short squeeze, but I don't often hear long squeeze. So this would just be a long squeeze, and it is because there is a shortage of demand and there is excess supply. There's a lot of people trying to sell out of their position because they bought in way too high, and it is creating excess supply, and there's not enough people wanting to buy.
This tells me straight away that there is someone up here on the seller side looking to push back down, going for short and taking profit. Okay, second attempt at breaking 580, straight back down to 560. So that's attempt number 2. Attempt number 3, pushing for 560. And the interesting thing is when he slammed down on 560, he actually went further south. So this satisfies my first criteria. 3 attempts to break out and fail. Now I need to see a similarity in the next minute for me to go for a reversal. So 540, so that means the sellers are quite in control at the moment. Hovering back at 560 again, so pretty even. Okay, interesting. We have an attempt to break through 580. And that fails, we're going back down to 560. If it attempts again at 580 and it fails, I'm going to buy in and go for a short. So at this point, 560 is where I will try to short with my stop loss around, let's say, 590. So if I'm buying in a 560 with stop loss 590, I'm trading 30 cents. So that means to satisfy my 2-to-1 criteria, the stock has to move at least 60 cents lower. So at 560, I want to see a bounce or a flush around $5, but we do know there is a level around 520. So we want to get we want to try to buy at 565 um, or around 570 if possible. So typically, what I would do is I would fill in a limit order around 565 and see if that buys in. Okay, we've got filled at 565.
So I would actually consider this entry a mistake on your execution because you could have actually just made money by entering the position better. And this is a trick that can help everyone watching if you are currently using limit orders like he just did to enter in this trade here. So you arbitrarily decided to put a limit order on 565 for a short. But what ended up happening is that I'm pretty sure at the max it went up to 571, and with very little trouble, like almost guaranteed, you could have entered at a range between 567 and 571. Now that is 2 to 4 cents higher than your entry at 65. And this may seem really minor, but on a $5.65 stock, that is actually almost 1%. I think it's 0.007. Now, if you're able to just make 1% profit or nearly 1% profit on every single trade that you take just by having good execution, actually, we can say 1% easily because if you can do 1% on the entry, or excuse me, 0.007 on the entry and 0.007 on the exit, then that's 1.4%. So you can make 1% just by doing better entries. And I haven't actually explained what the better entry would have looked like, so allow me to do that real quick. What you could have done is instead of shorting or selling the stock at 565, you could have used sell on the ask, and you would have been able to get filled in that range that I mentioned, which was 567 to 571. It bounced back in that range for long enough that if you just clicked your hotkey, bam, you're in. Man, I took way too long to explain that for something so minor, but guys, this thing can actually make you a lot of money, and it is so easy. Execution is really something that is quite simple and may not appear to be so impactful, but really, it can make you a lot of money just by having proper execution.
We have a finger on the stop loss at around 590. We're looking for straight down to around $5. We want to potentially take half of our winnings around 520.
So I want to give you a little bit of props before I tell you why I think what you're doing is bad. And what the props is that you're in a trade and you have a plan. You know what you're doing. You have a defined stop loss and you have a defined profit target. Now here is where I have a little bit of problems with what you were saying. Now I agree with where you set your stop loss. It makes sense. You put it 10 cents above the high of the previous high of the day, which is, it's somewhat reasonable. I personally don't trade with that much of a that wide of a stop loss. I'm very, very tight with my scalping, but to each their own. But then your profit target is just completely arbitrary, and the only reason you set it to $5 is because you're trying to maintain a 2-to-1 profit to loss ratio. If you're not going to sell until the stock hits $5, then there's a chance that you can be up, I don't know, let's just say 1.5, right, for the risk to return ratio. You could be up 1.5 and you're not allowed to sell out because you're not at a 2. And to me, that's just ridiculous because if all of the technicals are telling you, hey, it's going to hit this like 1.5 profit area and then it's going to bounce off, obviously I'm going to sell at the 1.5 even though it's not a 2-to-1 risk to reward ratio. So that is my qualm with the whole risk to reward ratio that is preached among other trading YouTubers. I personally do not trade with any defined risk to reward ratio. I'm just a free spirit. I trade any risk to reward ratio if I think that I know what's going to happen on the stock. And guess what? It works most of the time. So I'll say that. I do think that very frequently I can, like, I don't know. I don't believe in defined risk to reward ratios because it led to you picking a very arbitrary profit target that really just doesn't make a lot of sense. Even if the trade works out, there's going to be a million instances where it doesn't.
Looking at the tape, 530. Still quite bearish. 520, exiting half. Still quite bearish. He's trying to slam. We passed slam through. So it's now we just broke the 520. Another slam. We went through it again. So it's still quite bearish. So I'm trying to exit around 510. We just exited. Let's get rid of it all. And so we just got out. That's pretty much it. So I have about 20 seconds on the clock. So I will try to exit at the next possible ideal situation. I basically trade like this for the last 10 stocks I've replayed, and it all worked out all right besides one. But I would like your thoughts on if there are sort of any things I'm missing or any things I'm sort of not executing correctly.
So I think overall, I got most of my thoughts and things that I recommend out of the way earlier in the video. I do want to commend you for having a well-structured approach in this trade. You had a trade idea. You knew that at the 580 level was a level that you were expecting it to reject off of and then continue to flush down, and your trade idea happened, and then you had a plan to execute on it, and then you fulfilled that plan and brought it into you fulfilled the plan and brought it into fruition. So that's like the three kind of components that I identify when it comes to trading. You have to have an idea, you have to have a plan, and then you have to have the execution. So I think that your trade idea overall was a good trade idea, and I think that your plan, I think that the stop loss part of the plan was pretty good. I think that the profit target part of the plan was actually bad. And then lastly, about the execution, I think that the execution, again, it worked and it wasn't horrible, but I think that there was obvious room for improvement and that you could have captured more both on the up and the bottom, or like the short and the cover, right? Because you could have made an extra 2 to 4 cents whenever you shorted, and then whenever you covered, there was a lot of potential to make more profit. I don't want to keep this going on too long. I do think that overall, this was a great video to review and that it will be very educational for anybody who has watched it up to this far. And speaking of which, if you've made it to this far, this is a long video, so I appreciate you for staying through this whole time. Leave a comment in the description, not in the description, in the comment section if you made it this far, and let me know, because I'm actually really interested if you guys are going to make it this far. And if you haven't already, hit the like button, subscribe, and don't forget, I'm going to be live streaming on October 12th and then every Monday thereafter, probably. See you all later.